Tonight, you're going to open an app and look at two numbers. One is your debt, one is your investment balance. You feel like they're fighting each other, but the real answer is far stranger. They're not fighting. They're the same number wearing two different masks. Here's what nobody tells you. A loan and a bond are the same instrument, just with the signs flipped. When a bank lends you money, it holds a bond. You hold the debt. When you buy a bond, you become the bank. Someone else holds the debt. Same contract, same math. Opposite side of the table. Did you ever think of your credit card that way? Meet Jake. Jake pays the minimum on everything. His card, his car, his student loan. Every spare dollar goes into his 401k instead because he heard the market returns more than his interest rate costs. On paper, that sounds smart. Meet Vanessa. Vanessa does the opposite. She throws every spare dollar at her debt. She wants it gone before she invests a single cent. She feels like the responsible one. Jake feels like the smart one. Here's the twist. They're making the exact same mistake. Neither one has calculated what they actually own. Jake thinks he owns a diversified 401k. He doesn't. He owns a leveraged stock portfolio, financed by debt he refuses to pay off. Every dollar he puts in the market is borrowed money in disguise. Vanessa thinks she owns nothing but a debt problem. She actually owns a hidden bond portfolio, and she's the issuer. Neither of them sees it. Why does nobody see it? This idea isn't new. It goes back to 1958, when economists Franco Modigliani and Merton Miller published a theorem that quietly rewired how finance actually works. Their claim was almost insulting in its simplicity. Under certain conditions, how a company finances itself, debt or equity, does not change its underlying value. A dollar of debt and a dollar of equity are just two costumes on the same balance sheet. Wall Street spent decades trying to prove them wrong. Mostly, they couldn't. Now, bring that idea home. Your household is a tiny company. Your assets are one column. Your debts are another. Your 401k statement doesn't show you the whole picture because it only shows one column. Page 4 is where the real number lives, the number almost nobody reads. It's your net exposure to the stock market once your debt is factored in. Most people have no idea what that number is. Do you know yours? Here's the crash test. Say you have $120,000 in a 401k invested at a typical 80% stock allocation. That's $96,000 of real market exposure. Now say you're carrying $48,000 in debt at an average of 9% interest. That debt behaves like a short position on a bond. When markets fall, your 401k drops. But your debt doesn't drop with it. It sits there, fixed, compounding against you every single month. In a serious downturn, someone in this position doesn't just feel the market's usual pain. They feel something closer to 67% more pain because the debt keeps charging interest while the assets keep shrinking. Two forces pulling in the same direction, down. This is why Warren Buffett has said for decades that he considers debt one of the few things that can end an otherwise good investor. Not because debt is evil, because debt removes your ability to wait out a bad year. And waiting is the entire strategy. So what should Jake actually do? Think about the loan he's ignoring as a bond he could buy back. A credit card charging 24% interest is a bond paying 24% guaranteed, tax-free, with zero market risk. No stock index has ever promised that. Paying off that card isn't the cautious choice. It's the highest guaranteed return available to him, full stop. Every dollar Jake sends to his 401k instead of that card is a dollar choosing a lower, riskier return over a higher, safer one. Would you make that trade if you saw it written out plainly? Now, think about Vanessa. She's attacking every debt with the same intensity, treating a 22% credit card the same as a 4% mortgage. But a mortgage at 4%, when inflation runs higher than that, is closer to free money. Paying it off aggressively isn't discipline. It's giving up a bond that's quietly paying her to hold it. This is the real lesson behind the debt snowball versus the debt avalanche debate that creators like Dave Ramsey and Ramit Sethi have argued about for years. The method matters less than most people think. What matters is the stop line, the interest rate, where a debt stops being a financial decision and starts being a psychological one. Here's the framework, the one that actually answers the question honestly. Line up every debt by interest rate. Anywhere the rate sits above what a diversified stock portfolio has reliably returned over decades, roughly 7 to 10% after inflation, that debt is your highest guaranteed investment. Pay it first. Anywhere the rate sits below that line, the math tips the other way. And investing tends to win over the long run, especially inside a 401k with an employer match, because that match is an immediate, guaranteed return. No market can beat. That's the stop line. Everything above it is debt. Everything below it is an investment opportunity wearing a debt costume. There's a study worth knowing here, too. Behavioral researchers looking at debt repayment have repeatedly found that people don't actually pay off debt using the math, they pay it off using momentum. That's why the snowball method, paying off the smallest balance first, regardless of interest rate, keeps beating the mathematically superior avalanche method in real life. Vanessa isn't wrong to want quick wins. She's wrong to assume quick wins and smart math are the same thing. They aren't. One keeps you motivated, the other keeps you rich. Ideally, you want both. Consider one more piece of history here. Financial planner William Bengen spent years studying how portfolios survive decades of withdrawals, and his research became the foundation of the famous 4% rule for retirement. His work assumed something quietly important. It assumed a retiree carries no high-interest debt eating into that withdrawal rate. Add a 24% credit card into Bengen's model, and the safe withdrawal number collapses, because the debt is silently withdrawing money from the household every month, whether the retiree notices or not. This is the part nobody puts in the headline. A debt balance doesn't just sit beside your retirement plan. It quietly rewrites it. Now think about what a bank actually does for a living, because it explains why this whole idea feels so unfamiliar. A bank takes in deposits, pays a small interest rate on them, and lends that same money out at a much higher rate. The difference between those two rates is the bank's entire business model. When you carry a credit card balance while also holding investments, you are accidentally running a worse version of a bank against yourself. You're paying yourself a low rate on your investments and charging yourself a high rate on your debt, and somehow calling that balanced. A real bank would never accept that spread. Why would you? This is also why so many conservative retirement calculators quietly mislead people who carry debt. A target date fund advertised as low risk, holding 60% stocks and 40% bonds, looks tame on its own. But layer $48,000 of debt underneath it, and the household's true risk profile shifts sharply toward aggressive, because that debt behaves like negative bonds pulling the allocation the wrong direction. The fund's label never changes. The real math underneath it does. So back to Jake and Vanessa. With $48,000 in debt, $120,000 in a 401k, and $600 a month in spare cash, the honest answer isn't pick a side. It's sort the debt by rate, capture any employer match, no matter what, throw everything extra at anything above the stop line, and only then build the investment account further. That's not balance for the sake of feeling balanced. That's math, doing exactly what it's supposed to do. That single sorted list, rate by rate, is the entire framework, not a debate, not a personality test about who feels more responsible. Just a spreadsheet, ranked from highest guaranteed cost to lowest, that tells you exactly where your next dollar belongs. Here's the modern mirror. Every time you check your 401k balance without checking your debt balance in the same breath, you're reading half a balance sheet and calling it the whole picture. Every time you feel proud of an investment return without subtracting what your debt cost you that same month, you're celebrating a number that was never fully yours. The market doesn't know about your credit card doesn't care about your market gains, but your net worth, the only number that actually matters, sees both of them every single day. Tonight, you're going to open that app again. You're going to look at your debt, you're going to look at your investments, but this time, you already know they were never two separate numbers at all. They were always the same number, wearing two different masks.